All right, before we get into anything else today, I need you to understand something, because once you see this, you cannot unsee it. There is a signal sitting in the silver market right now that has only shown up a handful of times in the last 20 years, and every single time it showed up before, what happened next was not small. We are talking about moves that took people's accounts and changed them. And the wild part is almost nobody is talking about it. Not the big finance channels, not the mainstream guys, nobody. So if you're new here, stick around, because by the end of this video, you're going to understand exactly what this signal is, why it matters, and what I think happens next. Let's get into it. First, let's just check the board, because context matters. Silver right now is trading around NINSERQR CLVR price C, and gold is sitting at HINSERT gold D preview. The gold to silver ratio is around CANSERQR and rate IO. Now keep that ratio number in your head, because we're going to come back to it later. And when we do, it's going to matter a lot. Now, here's the thing I want to start with. And it's something that legendary macro investors have said for decades, too. Built one of the greatest track records in history, not by predicting the future with certainty, too, but by paying attention to how markets react to information. He's talked about this many times. It's not about being right on the fundamentals. It's about watching how an asset behaves when the news comes in. If the news is bad and the asset doesn't go down, or it goes down and snaps right back, that tells you something important about who's left to sell. That's positioning. That's exhaustion. And that's exactly what we're starting to see in silver right now. So let's get into the actual signal, because this is the heart of the video. Every week, the CFTC puts out something called the Commitment of Traders Report, or the COT Report. This report tells you what the big players, the commercial banks, the bullion banks, the hedge funds, the speculators, are doing with their positions in the futures market. And right now, according to the latest COT data, the commercial banks, these are the guys who are almost always short silver. That's basically their business model. Their short position is sitting at or near HINSERT and CRT or LVL, e.g., a multi-year extreme or specific contract number. Okay, let that sink in for a second. Now here's why this matters so much. Historically, when the commercial banks get this extremely short, and at the exact same time the price of silver is not collapsing under that pressure, when the price is actually holding or grinding higher. That combination has marked some of the most important turning points in silver's history. We saw something similar to this back in HINSERT period, e.g. 2008 lows, 2015 lows, late 2019 heen. The commercials were maximum short. The speculators had basically given up. And then the price did something the commercials did not expect. It went up. And when commercials are wrong on a position that size, they don't just sit there and take the loss quietly. They have to cover. And covering means buying. And buying into a market that's already moving creates the kind of move that doesn't look like a normal day in the market. So that's the rare signal. Record or near record commercial short positioning, too, happening at the same time as a price structure that refuses to break down. That combination is rare. That combination is the kind of thing that, when you look back at it 5 years from now, you go, oh, that's when it started. Now let's zoom out, because I don't want you to think this is just a one chart story. Let's talk about the price action itself. Silver has been building what a lot of technical analysts would call a base. We had a pullback. We tested support around HINSERT And instead of breaking down through that level and continuing lower, the market held. It actually reclaimed the 200-day moving average, which is sitting around HINSERT 200 DMA LVL. Now, for those of you who don't follow technicals closely, the 200-day moving average is just the average price over the last 200 trading days. It's slow, it's not flashy, but a lot of big money pays attention to it because when a market reclaims that level after being below it, that's often a signal that the character of the market has changed. And here's the part that connects back to the COT data we just talked about. When you have the commercial's maximum short and the price reclaiming a major moving average, and the speculative positioning, meaning the regular trend following funds, still sitting near historic lows in terms of how many contracts they're holding, what you have is a market where almost nobody who would normally be buying has bought yet. There's no crowd in this trade. And that, to a guy like me, is exactly the setup you want. He said it himself. He doesn't like getting into things after everyone else already has. The risk-reward is terrible at that point. The risk-reward is best right here, in this kind of quiet, under the radar moment, before the move actually shows up on people's screens and they start chasing it. Now let's talk about the dollar, because you cannot talk about silver without talking about the dollar. The DXY, which is the index that measures the dollar against a basket of other currencies, is currently at HINSER DXYLEL. Now here's the historical piece that I think people forget. Go back to 2001. The dollar index was up around 120. By 2011, it had fallen to around 75. That's a massive decline in the value of the dollar over that decade. And during that exact same period, silver went from under $5 an ounce to nearly $50 an ounce. That's a 10 times move. I'm not saying that happens again on the same timeline, but I am saying the relationship between a weakening dollar and a strengthening silver price is not some new theory. It's one of the most well-documented relationships in markets, and right now the dollar is showing real signs of weakness again, too. Let's bring this back to the gold-silver ratio I asked you to remember earlier. Right now that ratio is around HINSER. Historically, when this ratio gets stretched to extreme levels, meaning silver is extremely cheap relative to gold, it tends to mean revert hard, and usually silver is the one that does most of the moving, not gold. Back in HINSERT historical period, the ratio got up to similar territory, and what followed was a period where silver dramatically outperformed gold. If that ratio simply moves back toward its longer-term average, that alone implies a significant move higher in silver relative to where it sits today. Now, I want to address the macro backdrop here too, because none of this happens in a vacuum. We've got high SR2 macro KNTXT, e.g., Fed policy stance, interest rate expectations, any recent geopolitical developments affecting markets. And here's something Im has talked about for years. He pays extremely close attention to liquidity conditions and central bank policy, because that's the tide that moves all the boats. When central banks are forced to choose between fighting inflation and managing a debt load that's become unmanageable without low rates, history shows which one usually wins eventually. And every time that has happened throughout history, hard assets, gold, silver, have been the beneficiaries. Let's talk fundamentals for a second too, because the setup isn't just technical and positioning based, it's also structural. Industrial demand for silver, solar panels, electric vehicles, electronics has been growing every single year, and projections for the next several years show that demand continuing to climb. At the same time, mine production has been roughly flat, in some years actually declining slightly. When you have a market where demand is structurally growing and supply is structurally flat, that imbalance doesn't just disappear. It gets resolved somewhere, and historically in commodities, it gets resolved through price. So now let's pull all of this together because I want you to see the full picture the way I see it. You've got a rare COT setup, commercial's maximum short, which historically has marked major lows. You've got a price structure that just reclaimed its 200-day moving average after testing support and holding. You've got speculative positioning still near historic lows, meaning there's no crowd in this trade yet. You've got a dollar that's showing signs of renewed weakness, which has historically been one of the most powerful tailwinds for silver. You've got a gold-silver ratio sitting at a level that has historically preceded silver outperformance. And underneath all of that, you've got a structural supply-demand imbalance that isn't going away anytime soon. Individually, any one of these things might just be noise. But when you stack them all up together, happening at the same time, that's not noise anymore. That's a signal. And it's the kind of signal that historically has not stayed quiet for very long once the broader market starts to notice it. Now, I do want to give you the other side of this too, because I'm not going to sit here and tell you this is guaranteed, because nothing in markets ever is. Silver is volatile. It can have sharp pullbacks even within a longer term uptrend. And if COT Report resque festu reg, the dollar suddenly strengthens, a major Fed surprise, a risk-off event in broader markets, you could see short-term weakness, even if the bigger picture remains intact. The way Druckenmiller has always approached this is simple. He sizes positions based on conviction, and he's not afraid to be wrong and adjust. The point isn't to bet the farm on any single signal. The point is to recognize when the odds have shifted meaningfully in your favor too, and to position yourself accordingly with your eyes open to the risks. So here's my takeaway for you today. This commercial short positioning, combined with the price action we're seeing, combined with everything else stacking up around it, this is the kind of setup that doesn't come along very often. Most people are not looking at this right now. Most people are distracted by whatever the headline of the day is. But the data doesn't care about headlines. The data is telling a story. And right now, that story is about a market that's been heavily bet against by people who might be about to find out they bet wrong. If you've made it this far, you're exactly the kind of person this channel is for. Somebody who wants to look past the noise and actually understand what's happening underneath the surface. If this video helped connect some dots for you, hit that like button. It genuinely helps this channel reach more people who need to see this. Drop a comment and let me know. Are you watching this signal too, or did this catch you off guard? I read every single one. And if you haven't subscribed yet, now's a good time, because we're going to be tracking this setup closely in the days and weeks ahead. And you do not want to miss what happens next. Thanks for watching, and I'll see you in the next one.